Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by Paramount Residential Mortgage Group.
In today's mortgage environment, providing our wholesale community with the best combination of product, pricing, technology, and service is paramount to their success. PRMG, built by originators for originators.
Welcome to another edition of Master of the Markets. I'm Barry Habib, and MBS Highways created exclusively for NMP TV, and it's brought to you by our friends at PRMG. They're working for your best interest. Exciting week last week, wasn't it? Some big news on housing and jobs. Now this week it's a quiet week, but let's talk about it. First of all, mortgage bonds, they're battling a ceiling of resistance. We'll see which way that goes. And the 10-year Treasury's been kind of stuck between 65 and 70 basis points. The news of last week was really interesting. So it has to do with jobs and housing. And we did get the big jobs numbers, quite disappointing as far as the number of job creations. But what was interesting was the unemployment rate. Seemed good on the surface. It went down from 8.4% to 7.9%. It's not bad, right? Looks like things are improving. But it was for all the wrong reasons. A mass exodus of people, like 800,000 people leaving the workforce. So when you have a smaller workforce, those that are unemployed divided by a smaller number, it looks as if the amount of people who are unemployed represent a smaller share. So clearly, if those people were still in the workforce and counted as unemployed, you now have a larger amount of people that are unemployed that will be factored in. But given the fact that they're not counted in the workforce, I think we got a reading that was kind of fictitious there. You know, the household survey is what does it. This is where they call people. Just 200,000 jobs created there. I mean, I shouldn't say just 200,000 plus jobs because that would normally be a big number. But in a recovery like this, you're hopeful that you get bigger numbers than that. Now, remember, the amount of people that are receiving some sort of benefit for either normal unemployment insurance or this pandemic unemployment assistance, it's somewhere close to 24 million individuals. A typical situation before COVID would be about 5 million people that were receiving benefits. So lots of folks having a tough time coming back to work. And maybe it's because they're hesitant to do so. Who knows? Perhaps there's health concerns. Maybe coming back to work instead of receiving benefits for staying at home. Listen, it's not a picnic to go to work for a lot of people either. So staying home is easier. Plus, no child care to worry about. Don't have to worry about transportation or dry cleaning or tolls. You know, these are all factors that people might say, I'm not going to come back quite yet. Well, what does that do? That means that since people are increasing demand, now you've noticed this, the roads are getting more crowded, stores are getting more crowded. So increased demand, you don't have that supply, it causes a little bit of inflation. And we did see that last week. The PCE, personal consumption expenditure, that's the Fed's favorite measure of inflation. Those numbers were hotter. We've seen those rise. Now, they're still beneath the Fed's target, but they are on the rise. The trend for the last 2 months is still showing that we are gaining at a significant clip. So if that is going to continue into the future, mortgage bonds are not going to like that. Interest rates are going to have to go up a little bit to compensate investors for that. And additionally, in the jobs number, what we saw was some wage pressure inflation. Now, everybody looks at hourly earnings. And while that did rise from 4.6 to 4.7%, you know, the amount you get paid per hour, that's one thing, but that doesn't necessarily translate to how much you put in your pocket, right? What translates there is what very, very few people look at, but we've been explaining this to you. Look at weekly earnings. Now that went up from an already hot number of 5.3% to 5.6%. That's huge. And it's so funny to see people that look at the housing numbers that get it so wrong. People like Adam Data, people like Dan Olick and CNBC who say, hey, there's an affordability crisis. Prices are going up too fast. You can't afford it. And they cite a rise in the median home price, which was 11%. But that's not what home values are going up. That's the median home price. What does that mean? It means half the people bought above that price point, half the people bought beneath that price point. And maybe that median point moves here or there. Doesn't mean prices move. You could have the median home price going up, but overall, all the prices could be moving lower or vice versa. What you really look at is appreciation. And we got that last week too in an action-packed week. Appreciation levels a little under 5%, 4.8. So you might say, hey, wow, earnings are going up 5.6, 4.8, super affordable. That's true, but it gets even better because you don't use all of your income every month for your mortgage payment. You use a small amount, 20%, 18%, 25%. Remember, just principal and interest. So if that portion is being pushed up higher because home price values, now remember, you take rate into consideration, and rates have been actually going down compared to last year, you've got a lot more affordability. Look, 5.6% increase in incomes on a weekly basis. I know it's going to sound crazy, but home prices could go up 20%, and they'd still be more affordable than they were a year ago, based upon the fact that you don't use all of that income. So the realtors that you work with need to hear this, and you can explain that to them. So this is a great situation we're in housing. And certainly we hope that the economy does pop back. But I want you to be on guard here, because I do think this inflation could push interest rates a little bit more to the upside. Are they going to go to 6%? Hey, you may not see 6% in your lifetime anymore on the handle on mortgage rates, but I think in the short run, we could be due for a little bit of a rise in rates. So let's get people to understand that they got to respond and act quickly. Now, this week, as I mentioned, it's a quiet week, but we're watching the technical indicators. Look, if you are not on MBS Highway, you're nuts, okay? And if you're not doing the course for Certified Mortgage Advisor, go to becomecma.com. I'll give you a little present here for you just for the next few days. Put in CMA, MBS, save you $500. You're going to wind up doing it anyway, because everybody else who's going to be doing it is going to be so far ahead, you're going to need to catch up. So why don't you be the one who's ahead? BecomeCMA.com, put in the code to save yourself $500 of CMA, MBS, take the course, be better, protect yourself and your family, beat your competition. FinTech's getting all this money. You don't think they're coming after you? Come on, get on board and be on the cutting edge and do something for yourself that will change your life for the better. Hope you guys have a great week. Bye-bye.
PRMG continues to provide our wholesale partners across the nation with better technology, better product, better pricing, and better service. Our nationally recognized brand is more than just an image. It is a symbol of integrity. PRMG, built by originators for originators. Be sure to click on the link below for your free 30-day MBS Highway trial.